Hey everyone, it's Tony Leonardi, your certified financial planner professional from Newtown, Connecticut, and author of A Smarter Way to Retire. Back with another episode of A Smarter Way to Retire. Last week we discussed the Charitable Remainder Trust. Remember, where the charity gets what remains in the trust at the end of the term. This week we're talking about the opposite. Its cousin, a different but related advanced planning strategy called the Charitable Lead Trust, often referred to as a CLT. So what is a Charitable Lead Trust? Well, in simple terms, you transfer assets into an irrevocable trust. The trust then makes regular payments to one or more charities of your choice for a set number of years for the term of the trust. At the end of that period, the remaining assets pass to your children or other beneficiaries. So you can see how this is the opposite of a charitable remainder trust. The payments go to the charity, the remainder goes to your family. Okay, that sounds interesting, but why would one want to do this? Unlike a charitable remainder trust, a charitable lead trust typically doesn't provide much of a large current income tax deduction. Its primary advantage is in the estate and gift tax area. It can help reduce the value of your taxable estate passed on to your heirs while supporting causes that you care about. So I said reduce the taxable value, and that's the key to this strategy. Let's look at a hypothetical but realistic example. Consider a married couple in their late 60s, a combined estate of $42 million, made up of a small business, real estate, investments, etc. Under 2026 rules, they have between them a $30 million federal estate tax exemption. So without planning, the $12 million above the $30 million exemption will be subject to a 40% federal estate tax, plus possibly, depending on where you live, a state inheritance tax, resulting in at least $4.8 million, if not more, in federal and state inheritance taxes. And this number will obviously grow as your estate grows over time. If you have a large estate and it continues to grow, you're partnering with the IRS for 40% on that growth as well. The goals of this couple are to support several charities that they care about during their lifetime and reduce the potential estate tax burden on their 3 adult children. They decided to fund a charitable lead trust with $10 million in appreciated assets, a mix of investment, real estate, and business interests. So here's how the strategy works. That trust pays out 5.5% per year to qualified charities for the next 20 years. At the end of the 20-year term, the remaining assets pass to their kids, to their family. They don't have to wait to pass away in order to pass these assets to their family. They'll pass after 20 years. And here's where it gets interesting. Assuming the trust assets grow at, let's say, an average of 6% per year, the strategy can potentially reduce the taxable value of that $10 million for estate tax purposes, because the IRS discounts that gift to the heirs based on the charitable payments being made first. Any growth above the IRS discount rate can pass to the family with reduced or eliminated estate tax exposure. Think about throwing that $10 million gift over the tax fence today and getting a discount on that gift. Once the assets are over the tax fence, the growth stays out of the taxable estate. So this approach could potentially save the family $2 to $3.5 million or more in estate taxes compared to doing nothing, while still allowing the couple to make substantial charitable gifts during their lifetime. And in the end, net of all taxes, their children could ultimately receive significantly more after-tax wealth. Here are a few important considerations. Charitable lead trusts are complex, irrevocable strategies. Once assets are placed in the trust, they generally cannot be removed. That's what irrevocable means. Also, there is some investment risk inside the trust, and the assets going to charity are no longer available to your family. So this strategy is not suitable for everyone. It typically makes the most sense for families with larger estates, who have a strong philanthropic desire and want to reduce potential estate taxes. So who might this strategy be appropriate for? Well, individuals or couples with estates well above the federal exemption. The federal exemption in 2026 is $15 million per person. How about those who want to support charity during their lifetime? Or families looking to reduce estate taxes while still passing significant assets to the next generation in a more tax-efficient manner. Charitable lead trusts are one of several advanced planning tools that some successful families explore as part of a thoughtful estate plan. As with any sophisticated strategy, it requires careful coordination with your estate attorney, tax advisor, and financial planner. If you're interested in learning whether strategies like this could play a role in your overall plan, I'm happy to help. I'm still offering to build your own smart retirement model at no cost or obligation while time slots are available on my calendar. You'll see how different approaches, different strategies could impact your probability of success towards meeting your goals and your legacy. You can book a quick 15-minute call on my calendar at leonardifamilywealthcare.com. Look for my contact and Calendly links. Thanks for listening, and remember, there really is a smarter way to retire. We'll see you next week.
Securities and investment advisory services offered through Mosaic Wealth Inc., member FINRA SIPC. Mosaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Mosaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Mosaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.